As dividend growth investors, something we tend to sacrifice when looking for that growing dividend yield is share price appreciation, because we're investing in companies that are mostly mature and they just have a ton of cash coming in that they don't need to plow back into the business, so they pay that out to us shareholders in the form of a dividend. But what if you can get the best of both worlds?
Okay, I'm listening.
Well, buckle up, Buttercup, because I have 4 companies that I think have the potential, while paying a dividend, to have some really nice share price appreciation as well.
Oh, I like money.
Hey, what's up? I'm Russ, and this is Dapper Dividends, where we largely talk about dividend growth investing. So if that's something you are on board with, give that a thumbs up and consider subscribing to the channel. I am in a little bit different digs here because I'm remodeling a gas fireplace, turning it into electric, which was right in the area I normally do record. I'd also like to thank you for making me a part of your investing journey as I share my nearly 20 years of investing passion with you each and every week.
Every single week.
All right, let's talk some dividends. First, we have Oracle. They have a $245 billion market cap. In 2020, they were the second largest software company in the world. They basically are a database management company for operating systems like Unix, Linux, and Windows, and they have been manufacturing hardware since 2010. They also have a stake in TikTok Global, and they provide cloud services to TikTok's US operations, which I think is great because it should continue to help grow that top line and expand their cloud customer base. And they recently announced they're acquiring healthcare software company Cerner for $28.3 billion, which is the largest in Oracle's history.
That's huge. So huge.
Cerner specializes in electronic health records, and I wonder if this could help Oracle push into a new industry that is likely to see data stored on bacterial DNA, which I think is just something fantastic to watch out for, because there is more and more data being uploaded every single minute.
There's too much data.
In the past 5 years, earnings per share is up 17.1%, sales is up 1.8%, and cash flow is up 7.9%. Oracle's dividend is currently at 1.43% and has been growing for 8 years with a 10-year compound annual growth rate of 16.4%, and the trailing 12-month free cash flow payout ratio is a respectable 47%. As of this recording, Oracle is down 8% over the last 5 days.
I'm down, but I'm not up.
One thing I really love to see is buying back shares, because there's less shares to spread those earnings out over, so it's going to increase the earnings per share. And Oracle has bought back almost 29% of their shares since 2017. And with their market cap at only $250 billion, yeah, I say only because Microsoft is currently at $2.5 trillion market cap, I think Oracle could easily push into and flirt with the $1 trillion market cap range in the near future.
You have no idea.
Next, we have ticker BWXT, which is BWX Technologies. They have a $4.4 billion market cap. They design and produce nuclear reactors, components, and fuel, mostly for the U.S. government, the U.S. Navy's submarines and aircraft carriers, and most recently NASA, as well as commercial nuclear components. BWX Tech was spun off from Babcock and Wilcox in 2015. Now, this is a little bit of a company that's near and dear to me, because that aircraft carrier you saw in the video was none other than the USS John C. Stennis CVN-74, which I did serve upon in the late 90s. So I think this is really interesting that they provide the nuclear components, fuel. They're basically the sole supplier to the U.S. Navy's aircraft carriers and submarines. In the Navy. BWX is currently down almost 30% from their recent and all-time highs. Their 5-year earnings per share is up 17.4%. Revenue is up 8.4%, and over the last 5 years, their cash flow is up 9.2%. The dividend is currently 1.76%, which has been growing for about 6 years. And the 5-year compound annual growth rate is currently a whopping 18.9%.
One whopper for the copper.
So a few concerns I have about BWX is that their free cash flow is negative over the last 2 years. Their research and development spending has pulled back just a little bit, and about 75% of their revenue comes from being the U.S. Navy's sole supplier of nuclear components.
Nuclear vessels.
So kind of like Lockheed Martin, with a solid chunk of their revenue coming from the F-35, BWX has about a 20% return on capital because of their monopoly on being the U.S. Navy's sole supplier. And that's good and bad, because political winds could shift and things could happen that get them cut out of defense budget spending.
Don't you dare try to cut me out.
But the future needs more clean energy, and BWX will have lots of opportunities also from Canadian nuclear power, nuclear medicine, NASA, and microreactors. As much as I want to love this company and jump in, I need to find out why their long-term debt is up 80% since 2017, and their free cash flow is negative the last 2 years. Those are a bit of a concern to me, but BWX technology is squarely on my watch list, and if you have any input on BWX, please feel free to share in the comments below.
We'd love you to let us know.
Next is Amdocs Limited, ticker DOX. They have a $9.26 billion market cap, and they are a global software company that was founded in Israel, and they serve customers across wireless, broadband, cable, satellite, and mobile financial services. You always have to look at what they're doing in the future, and in October, I read that they reported over 25 new 5G projects. Their CEO has an 89% approval and a 4-star rating on Glassdoor.com.
That's pretty good.
Yeah.
Pretty good.
Looking at the chart, Amdocs was steady and up and to the right until 2019, when they've hit some choppiness, which it's been that ever since, and I see pretty strong support though at $55. Their 5-year earnings per share growth is 14.5%. Sales are up 2.9%, and that cash flow is up 7.3%. Amdocs' dividend yield is clocking in at 1.94% and has been growing the last 8 years. Every year usually sees double-digit growth, and the 5-year compound annual growth rate is a very nice 13.5%, on top of a very low 24.8 free cash flow payout ratio and very low debt.
Very low, basically.
As I just saw with my kids at Christmas, the world is just so digital, and it's growing ever faster into the digital space. So companies like Amdocs are certainly going to have a place. I like to see that they're not even at a $10 billion market cap, so I think they have plenty of room for that share price to grow upwards. And, I just think companies like Amdocs are needed. So really a cool company that, if you haven't heard of them, you have now.
Thank you for letting me know.
Last, we have a company that I have just started investing in, which is Intel, ticker INTC. They have a market cap of $208 billion, and they are the world's largest semiconductor chip maker by revenue, and they are based in the United States. Now, Intel, I think, is really interesting, and I'm not looking so much as at where they've been, but where they're going. And I think they have a really bright future ahead of them.
Tell us all about it.
They will be offering foundry services to their competitors, which means that Intel will likely be manufacturing almost all of theirs and their competitors' chips in the near future. Patrick Gelsinger took the helm in February of 2021, which is giving Intel an exciting new direction. And as my pal, the European dividend growth investor, says, this reminds him of when Satya Nadella took over Microsoft and really turned Microsoft around. Intel is also attracting new talent. They recently hired the AMD GPU architect Vineet Goel in October of 2021. And the United States Department of Defense wants chips made here and not in China. Intel said it won a contract to supply leading-edge chip foundry services to the U.S. Department of Defense. And the FBI says it's a matter of national security. There's worry that China could invade Taiwan, which would put companies like Taiwan Semiconductor at risk.
Okay, now that's serious. That's serious.
This is the story that I'm watching, is that Intel is just part of a larger global event that's going on, A lot of saber rattling with China and Taiwan. And if China were to invade Taiwan, that's just going to make things messy. I think that would be great for companies like BWX and Lockheed Martin and all the defense contractors. And we see that the 5-year earnings per share is up 16.2%. Sales are up 7.1%, and Intel's cash flow over the last 5 years is up 10.5%. For a company that I think has room to grow, a really nice 2.71% dividend yield with almost 7 years of dividend growth. The 10-year compound annual growth rate is 7.7%, and it's only 32% of their free cash flow as a payout ratio.
Wow, that's great.
Since 2017, Intel has reduced shares about 12.5%. Now, I think it's really interesting if we look at Taiwan Semiconductor, they have a market cap of $557 billion, which is over double what Intel is. So I think that could be where Intel could be heading in the future. Again, we don't know what the future is going to hold, which is what makes life so exciting in both investing and your personal life and world events as we see what plays out with China. And they have an exciting CEO at the helm, Patrick Elzinger, and I just think there is a lot of room for Intel to go up and to the right, and I am going to keep adding Intel. Now, out of the 4 companies we talked about, I only have direct ownership in Intel, which I do plan to keep increasing, but the other 3 look very interesting.
Yeah, okay.
Hey, you know, I'm not the only dividend channel here on YouTube, so if you'd like to explore more and maybe find somebody else to give you a point of view alongside of mine, check out this video I did right here with 15 of the top dividend investing YouTube channels you should watch, and I will see you there.